Diversified Alpha is a multi-strategy fund. The investment objective is to achieve returns of 3 to 5% over the risk-free rate over a 3-year rolling period with a volatility below 5%. Now we do that in a pretty unique way. We seek to do that only with alpha, only with security selection alpha. It's a multi-strat fund, so we have between 12 and 18 strategies, and they're sourced from teams within Pictet Asset Management. Well, myself and the other 2 investment committee members have the opportunity to use all the alpha sources of Pictet Asset Management. So first, we do a quantitative screening of the approximately 60 strategies of Pictet Asset Management to look for persistent sources of alpha. And then we choose to meet with a number of them at investment committee meetings. The most important thing is we need to have conviction that the investment team is able to generate alpha in their asset class over time. We also then want to be aware of what the market conditions are and how suitable they are for that approach. And we want to have alpha sources that are diverse from each other. So we look at equity teams as well as fixed income teams. For example, in an equity team, we would look at a European equity team or an emerging markets team, and they would typically take long positions in certain securities as well as short positions. We construct the portfolio by taking the 12 to 18 segments that we identified as being the most promising sources of alpha within Pictet Asset Management. And then we want to take into consideration our conviction and the ability of the team to generate alpha in their asset class. And we also want to look at how suitable their approach is for their asset class given the market environment. A third factor we take into account is the interactions between the different sources of return. We want to make sure that there's no cumulative risk that occurs. Certain sources of alpha are correlated to each other. We want to take that into account as well. So the objective is to construct a diversified stream of different alphas. Of course, finally, there's a promise in the product, which is that the beta of the product will never be outside the plus or minus 0.15 range, and duration would never be above 1. So generally, the overall portfolio based on construction doesn't get outside those constraints. Should that happen, there's an overlay hedge that's put in place to make sure that the promise is kept. The benefits of the strategy are that in a liquid format, we're able to offer an alternative asset, essentially. We find this approach quite relevant in today's marketplace because yields are getting lower and lower in government bonds and other fixed income risk premia have been more and more compressed. Investors' portfolios are dominated by equity and fixed income risk premia, as they should be for very good reasons over time. However, investors have sought and continue to seek to have an alternative allocation. And I think what's unique about this product is that it is truly alternative. It doesn't recycle equity and fixed income premia to create an alternative product. It really looks to create the alternative return through idiosyncratic positions, long and short, across equity and fixed income asset classes.